Welcome and thank you for joining the Dohussle team for our first live webinar as part of the Dohussle sessions. For those that might not know about Dohussle, well, Dohussle is a platform that is aimed at supporting side hustlers and startups. We do this by providing useful information and carefully crafted content, which is hosted on our website, dohussle.co.za. We would like to welcome both our speaker for today, Phindile Tshabangu, and guest expert Nikita Mfenyana. Today's Dohussle session is part of the Small Business Growth series, which will review the operating landscape for business during what turned out to be a very challenging pandemic year. Included in the session will be highlighting key business opportunities as we all prepare for 2021. So before I hand over to our speaker, Phindile Tshabangu, let me quickly inform you of the following. We'll be running a quick poll during the session. So when the question pops up on the screen, simply select a suitable answer for you and submit. It's that simple. If you have any questions during the presentations, there is a chat box at the bottom right of your screen for you to send through. So feel free to fire away because your questions will be addressed during the Q&A session right at the end. Lastly, don't forget the session is being recorded. You'll be able to replay it over again should you wish to. I'll now hand over to our speaker, Phindile Tshabangu. Phindi, over to you.
Good afternoon, everyone. It's great to see you joining us today, and thank you for joining us on this Saturday, beautiful Saturday afternoon. During load shedding, so the sacrifice is appreciated. My name is Phindile Tshabangu. I'm an entrepreneur and a business coach. After spending more than 20 years in corporate, in the private sector, I spent half of that working with small businesses, have done over 10,000 odd hours of business coaching, working with small businesses, helping them grow strategies and seeing them grow and employ people and getting funding. So later on, I'll be joined by a guest speaker for today, Nikita Mfenyana, who has spent many years in business financing. So we're looking forward to hosting you and having you today. I have prepared a short presentation that I'll be sharing with you. So who would have thought 2020, the year that was? We would never have thought that in the history of our country, there would be a time where short-sleeve sales, even Nando's chicken, alcohol sales would all be banned, all because of a pandemic that no one had expected. So what we have planned today is just a few takeaways on our experiences as business owners from the pandemic. We know that there has been a lot more things that we can take away, but because of time, we've just narrowed it to 5 of those keys that we'll be looking at and exploring today. The first buzzword that hit us during the pandemic as business owners was the term essential services. That by the time the lockdown hit, only those businesses that provided either products or services that were deemed to be essential were allowed to trade. What that meant was that if any of your products or services was not in that category, you had to wait until the lockdown was over. And although in the beginning of the lockdown, our president did assure us that, look, we have to do this, and we were going to be in lockdown for about 3 weeks. What really hit business owners the worst was when the 3 weeks went into a 3 months and even longer for some sectors. So that obviously hit all of us very hard. Secondly, we've seen how the different sectors were impacted differently. Those in constructions were not experiencing the same as other sectors of the economy. We've seen that, for example, the tourism sector At the time, although it was expected that up to 80% of the businesses would close, thankfully it was not as high, but even then we know that 30% of those businesses have closed down thus far. And as we matters stand by now, over a third of businesses had went into liquidation. And with that, a high unemployment rate of up to 43%, and we know that even youth unemployment is even far worse. So sectors were decimated and the economy was rattled. What that meant is, to us as business owners was that although we started the year hopeful, we had our business plans, and even if you didn't have a business plan written up, but you would have had some plan going into this year and hoping that you're going to grow. We soon discovered that all those business plans that we were meant to expand, suddenly we had to rehash them into survival business plans. Fourthly, very few business owners really had contingency plans in the form of financial reserves. A lot of the businesses that I've worked with, their biggest frustration was that they had very little, if any, reserves. And that meant that during the period of the lockdown, they couldn't sustain themselves. And after the lockdown, the crisis even continued because, for example, some of the businesses that I've been working with in the food sector, they have experienced very high input costs. So things have gotten very expensive during the course of post-lockdown and towards the end of 2020, which then meant that the sustainability of their businesses was really brought into question. Lastly, the president made a commitment during at the beginning of the lockdown that yes, it was going to be tough, but guess what? Government has put aside relief funds that were going to assist small businesses during that period. But what we've discovered was, and not even just South Africa, the world over, the relief funds had with them were very badly structured. Most of them were not necessarily as easily accessible to business owners. So what really was put forward as a saving plan was not as helpful as many had thought. So that left many businesses a lot more confused and uncertain going into the future. However, it was not all doom and gloom. There were some pockets of resilience that I believe as business owners we can all draw from going into 2021. So we've looked at a few examples that we'd like to share with you today. Some of you may have heard of this brand called Drip. It's a pure township originated Black youth-led business, which has grown in leaps and bounds even during the period of lockdown. This brand has sold over thousands of sneakers within a very short space of time and has garnered multi-million rand. And it is also in the process of expanding as we speak. It has a vision to go right across Africa and go into various other ranges as well, specialized ranges for athletes, etc. So this is something to draw some inspiration from. We, as most of us are familiar with the brand Sweep South, a domestic on-demand service that was launched a couple of years ago. Obviously, during the lockdown, domestic work was not regarded as essential. So what that meant was that the hundreds of the domestic workers that were on their platform were without livelihoods. But Sweep South then launched a fund for 12 million rands, which at last count, they had managed to raise, based on their target of 12 million, they probably raised just under 9 million. So that meant that during a lockdown, they could at least sustain the domestic workers that were not able to work. So that was much needed relief to those that were dependent on this business for their livelihoods. And thirdly, it's another nice example of a friend of mine brought to my attention. Play Gym and Cafe in Cape Town. This is a local gym and cafe combo, which because the gym was not regarded as essential service, they had to pivot and they pivot into home and delivery service for fruit and veg during lockdown. And after the lockdown, when we got to level 1, they then reverted back into full-on gym. So this is another very nice example of how a business had to think out of the box and offer a service that could sustain them. Another example is a company called Pickup, which also is a startup for delivery, which does last mile deliveries. And because they were the delivery services were limited to only delivering essential products, they had to just refocus and expanding the types of products they delivered that fell within the category of essential products during that. And not only them, many other companies within the same space had to shift focus on what to deliver. So essentially what they did, which is a good lesson for all of us, is that they followed the money every step of the way. So those are just a few examples that some of you may be able to relate with and even follow on and take those examples into the new year. What then are the key considerations for 2021? A few thoughts that we're putting across. You've all heard of the term adapt or die. That this is the time for you to do that. We've seen that if you are not able to adapt, and looking at the examples we've given you, then going into the future, you are going to struggle. You have to be honest as to whether is your business on survival mode or growth mode, and just pivot accordingly. And as you grow, you have to build your capacity to adapt to a changing landscape, and looking at the products and services and what the demands that are coming out there. Secondly, customer acquisition is key. You have to expand the base of the customers that you serve. Consider things like e-commerce. 5 years ago, many small businesses would not even have considered using e-commerce, mainly because there was low barriers to entry, that there were high barriers to entry. But now we've seen there's innovative companies like Yoko that have really made sure that the barriers to entry are very low, and even a startup business starting, like yesterday, could easily plug in and use e-commerce to reach customers that you may not ordinarily have been able to reach. Thirdly, you have to really look at how you rebuild from the inside out. What do we mean by that? You've always had some form of clients. It's important to connect with them and ensure that the clients that you already have, how do you serve them better? How do you grow with them? We know it's important to grow and attract more clients, but at the same time, don't lose focus of the network that you already have and build from that a resilient business. Fourthly, entrepreneurship by its very nature, you are required to be persistent. You have to know that COVID-19, as we've seen now, the regulations are very much still intact. In fact, as we speak, Nelson Mandela Bay is very much under, a stricter lockdown than the rest of the country. So going into the first quarter of the year, at least, you should still be looking at the regulations that are going to still be hampering some of your products and services the way you are aiming to reach the market. But hey, just stay persistent. We've seen some examples of resilience. There are people that are even starting an airline, Lyft airline, that is starting in the middle of a lockdown. Lastly, consider bootstrapping. Bootstrapping, for those of you who are not familiar with the term, it's nothing else but being able to do more with less as a business. We've seen how businesses that have taken in a lot of debt in the past, when the lockdown hit, although there were relief payment holidays, those were good in the beginning. But guess what? Within 6 months, when those payment holidays had expired, businesses had to pay those back. And Nikita will be touching on this into how their experience as a funder has been, where now 6 months later, some of the businesses have not really got out of the woods yet, and how do they then move forward? Now to the topic of today. Really what we're aiming to do today is to bridge the two worlds of entrepreneurs and financiers. On the left, as you will see, it's people like you and me, excited with our teams, starting businesses and having those great ideas. But in order to do that, we do need finances, don't we? And then we go rushing to financiers who are on the right. And guess what? The financiers largely are not just activated by our passion and ideas. They are looking at spreadsheets and calculators, and you find that the communication lines between ourselves and them is not that good. So to help us appreciate the complexities of financing a small business and what is really out there, if you're really looking to access funding in order to grow for 2021, we have invited a dear friend of ours, Nikita Mfenyana. Nikita, who has been in this small business finance world for over 24 years. But what is very important about Nikita is that he has seen businesses really from small nascent idea businesses to businesses that are exporting over into the African continent and even into the world. Nikita, thank you for joining us, and over to you.
Thank you, Phindile, and I'm very glad to be here. I hope that I can share some tidbits on financing that will also help with your approach to funders, as well as what are the things you need to consider when you are approaching those financiers for the best chance of getting funding. However, before we even look at funding, I want to make sure, or you need to make sure, that it is really funding you need. Often when we say funding, we really mean we need something to accomplish something. So for instance, like a plumber or an electrician, and you think that you need to get funding in order to get a car to get to your clients. An option could be that you first look at the possibility of borrowing, because initially your likelihood of having many clients in 1 week is very low. So look at possibilities like borrowing, like hiring, or even ask the client to come and fetch you. And there you can market it as something where, you know, if you fetch me, I don't have to charge you a call-out fee. So that's the first aspect. Secondly, as Phindi said, if you've exhausted all your internal sources of funding, your bootstrapping and so on, what do you need to consider when you look at approaching a financier? What are the things that you want funding for? And you need to be very detailed. It's no use going to a funder and saying, I need approximately 100,000, and some of it will be for working capital, and some of it is for equipment. You need it to be detailed. If it's equipment, you need to get quotes. You need to know what are the warranties and what it will cost, for instance, to transport that equipment to your premises. If you're looking at things like salaries and wages, if you need people employed in your business, you need to break it down by positions, who gets how much, including things like UIF for every wage earner or worker that you're going to have. So it's important for you to know in detail what your funding is going to be for. Secondly, look at how much you can actually afford versus how much you need. And here you need to look at sometimes what is the term of funding that you're looking for, because there's different loans out there. Some are for 18 months, some are for 3 years, some for 5 years. Your affordability based on how long the term will be is quite crucial to take into account. And I can't emphasize that you need to know your numbers very well, backwards. Your top line turnover, how do you get to the turnover number? When you say, for instance, that your turnover in your projections is going to increase by 10%, what's the basis of you saying that? Be able to show what is the marketing effort that you've made to get to that 10%. Why is it 10%, not 5%, not 15%? You need to be able to back them up. Another aspect that you need to consider with financiers is your commitment in terms of how much are you prepared to lose if the business fails and you actually stand as surety for that business. In other words, the financier is there to make a profit. They'll give you or lend you the money, but they want to know that even if the business fails, that you will be able to make some kind of arrangement to pay. So often you have to provide either security in the form of maybe a bond over your house, or it may be at least surety to say, if the business fails, I may actually have to get a job to repay the loan that I'm getting. Another aspect that we often don't consider when approaching financiers is that the funding process sometimes takes long, in the sense that there's a due diligence phase, and after the due diligence, even after the money has been approved, it may take a while before it's actually disbursed, provided to you, because of certain agreements that have to be signed. If there's security that has to be registered, that depends on things like the attorneys and legal processes. So look at how long are you prepared to wait for that funding? What are your options? Because don't expect that if you've gone to a financier that you will have money in your bank in a week's time. It will probably take about a month just for the financier to do the due diligence, and there may be another month. In fact, in some instances, financiers or entrepreneurs have had to wait for up to 6 months before getting the funding. Last but not least, what happens if you don't get funding from the financier you've applied to? Who else have you got as a backup? And what happens if none of the financiers are actually able to provide funding? Have a thought around that. It is important to have a plan B. Having said that, we can move on to the next slide and look at what the funders will expect from you. First and foremost, be precise and to the point. If you are starting a small guest house with 2 to 5 rooms, there's no point waffling in your business plan about the world economy, about interest rates, and so on. Don't put in 100 pages when what is essential to put across can be put over in 2 to 3 pages, even if it's in bullet points. What the financier is looking for is that there's a logic to your business and your business model. Be able to determine, be able to show where are your clients from, where are your suppliers or service providers from, how do you generate the money, how do you repay that money? And in all those aspects, you need, the financier wants those numbers to be verifiable. In other words, when you are looking at a particular amount in terms of turnover or costs, be able to back it up. If you're saying you're going to gain 30,000 rands in your first month and then 40,000 rands in your second month, be able to show why you say so. Be able to verify also your costs, line item by line item, your rent, electricity, water, etc. The fourth bullet point deals with being honest and upfront with your financier. If you've got judgments, you better tell the financier upfront, because it's much worse if they find out after the fact, after you've presented a rosy picture of yourself. Usually financiers look at a business and say, okay, this person has admitted that they've had a judgment, and we can understand it's because he got retrenched or something happened. Therefore, it's okay because he's made a plan to clear his name or to repay whatever was being owed. What financiers don't want is, firstly, not to know about it upfront, and secondly, they don't want somebody who they perceive to be a serial defaulter. In other words, you've got 7 or 8 judgments in 1 or 2 years. That is not something that financiers will want to see. Last but not least, you need to consider what's in it for the financier themselves. Remember, they're in it to make money. So what is it that you can show that the business will make a profit and that you are able to repay? And what else is there that the financier can almost brag about? And we'll come to the type of financiers, but for some, it may be things like they're helping you to create jobs. So when we look at the different funders, and it's important, as Phindile earlier said, to match the financier specific to to an entrepreneur. There are a couple of different categories you need to look at. And if we go to the next slide, what I'm talking about is there's some financiers that provide funding up to a certain amount and not more. Others start from 5 million, and it's no use you applying to them if you only want 100,000. Second, there's financiers that look at only growth stages of businesses. So if you're a startup, there's no point going to them. There's often some financiers that look at particular industries. They either have specific industries as their mandate to fund, or they have industries that they avoid. Fourthly, we look at the purpose of funding. Some funders provide finance for working capital, but not for building. Others would finance buildings, but not machinery. So you do need to do quite a bit of research when you approach funders so that you go to the right funder. If what you want is working capital, don't go to West Bank, which only provides funding for machinery. Then there is a group of funders that look a lot at the developmental impact. All funders want you to make a profit. All funders want their money to come back to them. But some funders will have a higher regard for developmental aspects like job creation. And that's what's then important to put in your business plan. And last but not least, you also need to look at the structure that you're going to use. It doesn't necessarily have to be just a pure loan. Some funders will provide equity, which means they take a shareholding in your business. Others would fund you based on the turnover. So the higher the turnover, the more the repayment to them at that particular point of time. So look at all those aspects before you approach the funder. Now, coming to the actual funders, the first I've got are what we call DFIs, the Development Finance Institutions. These are generally government-owned institutions that have as their mandate not only making a profit or getting the money back, but having a developmental aspect, as I was saying earlier, the jobs, rural development, and so on. If we look at the specifics, SEFA, which stands for Small Enterprise Finance Agency, looks at amounts of funding from 50,000 to 15 million. And they cover more or less just about every industry that requires that, except for what we call sin industries like alcohol, cigarettes, gambling. What they look for, and part of their funding is targeted at startups, is the developmental aspects like youth entrepreneurship, township entrepreneurship, certain industries, and looking at female entrepreneurs as well as a preference. But that doesn't mean they exclude anybody. There's no exclusions with them. The NYDA, on the other hand, has a mix of funding that is both can be grant funding and loan funding. By the way, SIFA also has a small portion that could be grants depending on how developmental your business is. The NEF, on the other hand, looks at empowering people who were previously disadvantaged, specifically black businesses. So their starting criteria is a bit higher than SIFA's. I think it starts at about 1 million. But they also generally look at businesses that are not startups. If we go to the next level, the commercial banks, those, you know, ABSA, Standard Bank, and so on. What you must remember is their mandate is primarily to be the safe guardian of money. Their primary task is not to lend money to small businesses. And often that gets confused. People complain, why aren't the banks giving us more money? Why aren't they trusting or giving money to SMEs and startups? Their mandate is to make sure that your savings or pension or money that you get as a salary is safeguarded. Only thereafter will they be looking at providing funding, and therefore their criteria is very conservative. They want to make sure that if their money or your business goes down, they can recoup everything straight away. So they want good security, like a house, and you'll have to have more than the market value. They'll not give you the market value, in other words, of your security. Business Partners is an organization that focuses on small businesses, which is where I'm currently working. And we look more at also on a commercial basis, but what's the risk in the business and what sort of reward we want for that risk. So Business Partners does look at those businesses that are not fully secured, but for that, there is a higher price to pay. Then we have, of late, in the last 5 years, a proliferation of what we call fintechs. These are relatively smaller type companies that have come on the market, and their strength is digital technology. They are able to provide or get information using, you know, all the aspects of the digital age on you to assess your risk, and therefore they are generally quick at providing finance. Another is Yoco. Yoco, as Phindile earlier mentioned, is a company that provides your card readers for small businesses cheaper than the main banks. And how they finance you is that they, by seeing your transactions, they know how much you can afford, and your repayments to them is based on the turnover that you generate. So each time somebody swipes, they get a percentage of the money that's coming to you. Another source of funding is what we call invoice factoring. This is where a small business may have a blue chip client, like if you're a service provider to Woolworths, you know that often the big corporates don't pay straight away on your invoice. And to cover the gap between the time that you invoice them and you get your money, invoice factoring companies would give you, let's say if Woolworths has a contract with you and you're invoicing them for 10,000 Rand and they're only going to pay you in 30 days or sometimes 60 days. These factoring houses will provide to you not the full 10,000, maybe the 9,000. And you are basically selling your invoice to them. So when Woolworths pays, instead of paying into your account, it will be paid into the factoring account. But by that time, the factoring house has given you 90% of that money, depending on what their fees are. Last but not least, we need to look at opportunities from enterprise and supplier development. And this relates to, there's a large number of corporate companies that in order to have their BEE status maintained or improved, one of the factors they have as the BEE score is to support small businesses as their service providers. Those companies often don't want to have the hassle of actually determining who is the best service provider for them and dealing with them. So they provide funding to the likes of Edge Growth, CDI, Fetola, for them to put programs together for small businesses, which can include some funding, but more often it also includes things like training, equipment, and so on. So, and in some, like CDI is also, here I'm talking about the Craft and Design Institute. That's based in Cape Town. They look at funding small businesses that are specifically in the crafts and design space. So there's a variety of different funders. This is not an exhaustive list. There's a lot more. Importantly, the main thing is that you need to be able to identify who is the best funder for you and be able to prepare your business plan or your application in line with what's important for that funder. To get more information on various funders, you can visit a website called FinFind. They have upwards of 600 different financial institutions. And they also show what are the requirements of each institution. So I would say that, you know, as a point of reference, use the FinFind search engine that will give you an idea of who could possibly be the best funder for your situation. Now, having said that, I welcome any questions, and I'm sure we will move into that. But thank you for having me, and I'll hand over back to Phindile at this point.
Well, thank you very much, Nikita. I think what you said that towards the end is very valuable, that, you know, the list is not exhaustive. If we were to put all funders there, it would be a whole long list, but at least you've covered the fundamentals. And as you will announce at the end, we will be having a masterclass at some point where we will be having going into more detail into the specific funders. Please remember that you can, I've seen a few questions that have started to come through. If you have any questions for us, you can just pop a question into the chat box, and we'll try as much as possible to answer that. We're almost running out of time as well, so we'll be quick in just dealing with the questions. So Nikita, the very first question, one of the first questions that came through is very relevant from Samuel, and Samuel says you know, it's very difficult to access finance as a small business. That's obviously a frustration that we get on a daily basis. But his question specifically is that for he runs a cleaning services company. What sort of asset-based finance is out there to acquire assets and equipment? You've touched on one or two of those, but specifically on this, what's your take on it?
Thank you for the question. I think in terms of, if I understand correctly, the question is about getting finance for particular assets that are specific to cleaning.
Yes, specific to cleaning, but I think you can maybe frame it for, you know, asset-based type of other finance here.
I think the main issue is not really what type of, as much as we say, yes, you must be careful about approaching a financier for a specific type of asset, know that they finance them. The main thing that financiers are looking for is how profitable or viable is the business. For something like a cleaning service, depending on the amount, the likes of CIFA would be able to provide funding if you are able to show that your business is, ready for, in terms of viability, and in terms of being able to make the required repayments. The important question, the important thing to do is to be able to highlight exactly what equipment you want, what it's for, and how does that equipment improve your business. I think there's a number of other, even the institutions that are linked to the banks that deal with machinery finance. So I'm not sure I'm perhaps not very familiar with what would be required in terms of assets for a cleaning company. Then maybe the NYDA, if you are still youthful enough, could be the answer for you. Alternatively, look at the avenue of supplier development. Because if you are a cleaning company that could provide a service to Old Mutual, for instance, or Sanlam, they've got programs for their supplier development, which includes things like funding for certain equipment, certain training, and so on. So it's a case of really looking at who could possibly, firstly, the amount, and secondly, who could possibly be your customers for it? And then look at what are the available avenues in terms of supply development. Supply development is quite a big thing, and that I think would warrant almost a section on its own. But I think the main issue is to be able to show that your business is viable and is going to be profitable.
All right.
Yeah, I'll leave it at that.
Okay, so thanks a lot. I think that really from your previous slide, you were talking to it as well, that it's not all things to all people. You need to specifically look at the amount and so on, and then approach the relevant funder accordingly. So I hope that Samuel gets is answered on that one. Then another quick question here from Tumi. Tumi says, please elaborate on factoring funding. And they missed a bit on that. So are you able to just explain a bit in terms of how factoring work? Because some of the business owners are not do not understand the factoring.
What I was saying is that for you to be able to take advantage of factoring finance, which is really what we call invoice discounting, you need to have existing clients and good clients, because it relies on your clients that you are providing a service to, or you're providing goods to, being able to guarantee that they will pay you once you provide that service. And you are able to get money in order to provide that service. So, for example, as I was saying, if you are a service provider to a Woolworths or a Pick n Pay, MTN, any of the banks, and you know that the service you're going to provide is going to generate a certain amount of income. That income, but before you can get there, you need certain funding to be able to, whether for raw materials or working capital. You can provide the factoring house with that contract and say to them, I'm going to get this money, please give me money now, and you will get the money that I'm going to get at the time that the service has been provided and I've invoiced the client.
Okay. Yeah, I think that clarifies quite a bit, because as we know, factoring is not also as well understood. So thanks for that clarity. Um, the, the, the next question really is also kind of sectors specific. So Talente says that for the industry of cosmetics and fragrances, you know, are there specifics? I would guess so. Manufacturing would be more to talk to that, but you want specifically for cosmetics and fragrances. And then this related to that is another one, which is a different sector that Lisa is asking, is that, you know, do you have an experience of digital startups, particularly, you know, they're trying to stack a Stockfell type model for digital startups. You know, I know the funders that you've touched on, digital startups, and then the first one is on cosmetics and fragrances.
Okay, I'm not aware of a funder that deals specifically with cosmetics. You also need to differentiate, are you making cosmetics, which would fall under manufacturing, or are you selling, which would be part of retail? Both of which most funders would actually look at. Again, it really relies more on what is the viability of that business. I know CIFA, for example, would look at both those type of businesses. So would business partners. It's really at the end is dependent on the viability. And if you have security for some of the funders, that is a comfort level. For others, as I was saying earlier, it's a question of how many jobs would that generate. But whether it's cosmetics or any other industry, and I'll come to specifically the tech type of startups, the main issue that funders are looking at is to prove viability. Now, with the tech industry, there's some funders that will shy away from it purely because they don't understand it. And I think at this stage, the funding for a lot of the tech type startups is from what we call angel investors. People who have had their own businesses or who have come together collaboratively to look at funding things that are possibly have a very high potential in terms of once they get going, but that do require some time before the business generates an income. And in those cases, those are funders that would actually take up an equity stake usually, because the business often can't afford regular loan repayments from the word go. There's also crowdfunding that you could try, which is an aspect that is almost a technical way of a Stockfell. So you put yourself on a platform and say, this is what my business is about. I need funding. And people who are interested in that will actually also go onto that platform and pledge certain amounts to you, and you can promise them something in return. I think those are for tech startups, yes, at this stage, it's really a case of how well developed is it. If it's completely just an idea, it will need probably more equity finance.
Okay, so that's quite a mouthful then. So we just then in the process of wrapping up. So I think that we've covered very much the bulk of the questions that have been sent through us. In wrapping up, Nikita, so you've touched on a number of funders and you've seen all these questions that people are throwing. Then can we safely say then that with all the relief funds that have come and the funding that's out there, there shouldn't really be a shortage for someone with a viable sort of business plan and wanting to start a business in 2021?
I think there's two aspects to it. Firstly, in terms of the funds that were put out for the pandemic, there were the guidelines to most of the funders, the banks and so on, and others as well, was that it has to be businesses that were already viable before the pandemic. And therefore, you are bridging the period of, let's say, the lockdown of 3 to 4 months or 6 months. And after the lockdown, those businesses will be fine again. So I know that there was a lot of concern about why are the banks or financiers funding so few. And that relates to the mandate that I was earlier saying the banks have. The problem was that there were already a lot of businesses that were in trouble even before the pandemic.
Okay.
In terms of looking at, going forward, I think that there is a lot of funding available, but you do have to make sure that you know how to prepare your business plan properly. You need to know what is it that's specific to the funder that you are approaching. What are their criteria before you present your business plan? And you may need to tweak your business plan specifically for those criteria. So I'd say, yes, there is funding available, though again, almost nobody is going to fund purely an idea where you have not tried anything. They want to see that you've tried something. What have you put in? What have you show us that you've at least managed to get a couple of clients for your type of business? That proves that your idea is viable. Otherwise, if it's just an idea on paper and you've not spoken to any potential clients and they've not expressed any interest, that type of business, I don't think any funder will finance.
Okay, all right. Thank you. So there's another question from Tumi, who was asking about funding for the photography sector. Is there any specific funding for that sector?
Again, I don't see that I don't know of a specific photography sector. I do know that if you can show your photography business is viable, then a number of those financiers can look at it. But again, what do you as a photographer need funding for? Is it for the equipment? Is it, like I was earlier saying, is it to get a car to get to somewhere, and do you really need it? It's a case of, I battle to think through what a photographer, apart from the equipment for photography, what do you need the money for? Maybe that could give me a better clue. But irrespective of what you need the money for, I think it's more a case of what amount you need, and therefore looking at who funds those type of amounts. It's really based on viability. A photography business or a bed and breakfast or a guest house or a filling station, the difference is not much from a financier's point of view. Show me that you are able to make money out of it, and I'll fund you.
Okay. So you touched a bit on the price for funding or the cost of finance. I know that has been also a sticking point because of the, and I did speak about how people must avoid getting into debt. So are we going to expect going into the future more expensive business funding given the levels of risks, or given the low interest rate climate, would business owners also benefit from that? If I approach if some of these businesses approach a funder tomorrow on Monday, are they to expect kind of high interest rates as we've experienced previously?
I think there's a very wide range of funders, and there's a very wide range of prices. You get from the one side, if you're lucky enough to actually get a grant or get funding for some things that are interest-free, to the other end where you'll get very high interest rates. Now, I don't think that it's just about the interest rate, because if, as I was saying earlier, some financiers take a long time to do their due diligence and to disburse the funding. So for instance, if you approach one funder that has got relatively cheap compared to the others funding, and often it would be your DFIs like CFA, NYDA, NEF, because of their developmental impact that they require, you might find they can give you a loan at prime, prime plus 1, prime plus 2, which is very good currently, looking at the prime rate being 7%. But if it takes them 6 months to do the due diligence and disburse the funding, in those 6 months, you might end up maxing out your credit card. You might end up going to money lenders, mashonisas, who will charge you, I don't know how much, 100% per week, whatever. You have the likes of Lula Land and Yoko, which charge, I'm subject to correction, but something in the region of 3 to 4% per month. Now, 3 to 4% per month works out to upwards of 40% per year. So do the maths, because some funders will tell you that they only charge 3%, but it's 3% per month. Others say they'll charge you 10% or 15%, but it's per annum. So it's a number of things you need to consider, including, as I said, the length of time before you actually get that funding.
Okay, so thanks a lot, Nikita. I think we've covered quite a broad range of those. We understand that there's obviously been other specifics that have come through from the questions that come through. So here are our contact details. You can just pop us an email or a WhatsApp and say specifically which business and which funding in particular would you like to pursue, and we'll obviously be following up with that. And as I mentioned before, that we are looking at future sessions where we'll have a master class where we go into a lot more detail than we would have gone in today. But that kind of brings us to the end of our session for today. So we do thank you guys for joining us. And although you're just seeing myself and Nikita, we also have a whole team of Dohussle who are doing quite good work behind the scene. Fedi and Peter, thank you very much for pulling this together. Big up to you, Nikita. Our special guest, special guest. I've always learned from a lot of your insights over the years, but it's good that this morning or this afternoon rather, you made time to share it with all of our colleagues here. Thank you very much.
It's been my pleasure. Thank you for having me.
Over to the Dohussle team.
This has been a Dohussle session. We'd really appreciate it if you could rate our session now. We'd like to thank our speakers Phindile Tshabangu and Nikita Mfenyana for taking time to share their valuable insights with us. Thank you for joining us as well. And if you'd like to know more about Dohussle, please head over to our website, dohussle.co.za. Until next time, we wish you an awesome 2021 in business.